this is Claudia here from the Bookkeeping Experts, back for one more week of education with QuickBooks Online. Today we're going to talk about unearned income. What is unearned income? It's called, or it is classified as a short-term liability when the goods and service have not been provided. You have received the money, but the goods and service have not been provided yet. So the revenue is actually categorized in that short-term liability account. And when you provide the services to the customer, you transfer those funds into revenue. So here is how we're going to take care of that. We're going to go straight into QuickBooks Online. Okay, here we are. Okay, so here is our QuickBooks Online simple account. And I have a customer that have received money from their clients, but they have not earned the income yet. So they asked me how to record that, and this is how we're going to show. First of all, you have to create a liability account, and we're going to go ahead and click on transaction here, and then chart of accounts. If many of you notice the changes of QuickBooks Online interface, one of them is that the chart of accounts is under transactions now. It used to be under accounting right before my accountant. So everything changed here. All right, so here we are. We're going to create a new account. So we're going to do a plus new here. Okay, and we're going to select a liability account because that means you receive that money, but that money doesn't belong to the company yet. And I'm going to put under other current liability because, of course, the purpose here is to receive from the customer, but you're going to provide that service in a short term. So I'm going to call deferred revenue. Okay, and I can put here deferred revenue. There are other reasons why you should put under deferred revenue as well, besides a product that you have not necessarily have been provided. Sometimes it's bundle services, like when you sell a product that includes insurance or includes other services for like a year, you don't want to record the entire revenue when you receive the money from the client, because you still have to provide that customer service for a year, or that warranty for a year. So if there is any problem with the product, you may still service that, and you have to account for those expenses, and you have to account that money has not been earned yet. So a lot of the times you want to calculate that as a percentage. You may talk to your CPA how to do that. Of course, it all depends on your products and service and how you set up your bundle services. And sometimes it's just like a deposit that you receive for a service that you haven't provided the service yet. So there's several reasons that you could put that money under deferred revenue. But most importantly is that this money has not been earned yet. Okay, so we created that account, and now we're gonna go ahead and find an income transaction, okay, in banking. And we can either categorize straight from here. Okay, so you can click and open up. You can click on the number and open up the transaction, and we can put books by Betsy, and I can put deferred revenue over here and just enter as a deferred revenue. Okay. That's one way to do it, but this is considering that you have not invoiced the customer. This is like you are just recording that income coming through, and you have no invoice, no sales receipt, nothing. So you're just recording straight from the banking, and that's okay if you don't have any invoicing. But if you do have an invoice, you want to make sure that you do match it in banking. Okay, and I can show you how to create the invoice for that deferred revenue. We're gonna go ahead and open an invoice right now, and we're gonna create the invoice for Amy's Bird Sanctuary. we can do on receipt. Let's suppose that this is, like some kind of deposit, and I'm gonna add a new account because I'm gonna create that deposit. So I'm gonna call deposit. Okay, and remember that deferred revenue account here. I'm gonna route this product into deferred revenue. So that means that it's not gonna go to my profit and loss. It's gonna go to the balance sheet. Okay, so I'm gonna save and close until you have provided the service. Now I put it as taxable, but let's suppose that it's not taxable. So you want to go into your products and service and change that. Okay, so let me just go without. Oh, products and service, which should be here or under all lists. So let's go through here. And we created that deposit, and it's taxable. But let's suppose if it's not taxable, you want to add a tax and make it non-taxable. Okay, so remember, you need to have your product and service named as, it could be deposit or deferred revenue, or it could be whatever you want to call, because it could be warranty or whatever it is, right? And you want to make sure that this is routed to deferred revenue, which is that other current liability account that we created. Okay, so now we're gonna create an invoice. Okay, we are going to Amy's Sanctuary like we were. We're gonna select deposit, and now it's non-taxable. See that? I'm gonna say that it was $100, and I go ahead and save and close. Okay, if that cleared the bank, you want to make sure that you record that the customer paid that invoice, right? So let's receive payment. Amy Sanctuary. Okay, and that is the invoice for $100. Let's say that she paid today, went to undeposited funds. This is the workflow of the income, right? But this is going to go to defer revenue. Okay, so I'm going to record the deposit for the 30th, and I'm putting into the checking account and save and close. And now I would match it. Remember, the third step is to match it. So I would go to banking, find that $100 transaction, and match it. Let's just put this for $200 because we have this $200 transaction, and I wanted to show you how it is done. So actually, let me undo that deposit so I can show you. Click on the counter clock. It's going to show me my last deposit. I'm going to go ahead and delete. Means that I'm bringing the payment back to the bank deposit here, to undeposited funds, and I'm going to delete the payment because I'm going to adjust that invoice. Okay. So I brought it back. So I deleted the deposit, deleted the payment. Now it's the open invoice. And if I click on the counter clock, it's going to show me my last invoice. I'm just going to make it for $200 so we can match it in banking and you can see it. This is just a sample account, guys. All right, so save and close. And it went to undeposited funds. We're going to go ahead and select it. Oh, what happened? We just selected the payment. Okay, invoice. Oh, yes, I'm sorry. We didn't pay yet. We adjusted the amount, but we didn't record the payment. Now we record the payment, Claudia. Okay. I went too fast. Okay. Save and close. And now I have it under bank deposit, waiting for me to record this deposit. And I'm going to select the date is right, the bank is right, and voila! It matches here. Okay. So the two transactions that recorded, and we show you two ways to receive those payments, right? Will be recorded on that account. So if you want to see what's going on, we're gonna go to chart of accounts, we're gonna go to that deferred revenue account, and I can click on view register, and I'll see those two transactions. See that? I just added those two transactions here. Now let's suppose, oh, okay, this is for next year. Okay. Okay, let's suppose that you actually you provided the service and you earn this income. Let's say that $200, you provided the service, and now you're gonna record that you earn it. And how do you record that revenue? Okay, I'm gonna show it to you. There's a couple of ways. One, you can create an invoice and put it against that invoice. I want to show you the two ways. So I would create the invoice for Amy Sanctuary, and let's suppose that I earn the income for design. I'm gonna put 2.5. No. I'm just gonna put okay. I'm just gonna put the total as $200. That's it. Okay, there you go. $200, and everything looks good here. And then what I'm gonna do here is that I am going to deduct this amount from the deposit. Okay, and I'm gonna do a minus $200 here. So basically I'm creating a zero balance transaction. So it's an invoice, but it has a zero balance. But what this is doing is it's recording that I made the sale for design, and I pay for this with that account. So you see the money that was increased when we received the payment, and decreased when I provided the service. And when I provided the service, this will go into revenue. Okay, so this is going to show up in the profit and loss. So it's being taken out of this liability account and showing off as income. So if we go into the profit and loss, and I'm just gonna put for December, and that was $200 under design income. Okay, so it's mixed. If we click on the 2450, that $200 is going to be here. Okay, and there it is. See that $200 for Amy Sanctuary? So if you actually click here, you'll be able to open it, and now it's here. See that? So that's how you record that. One way to record that. So it's create an invoice, and then or a zero balance invoice, and pay that with the deposit. So one way to do that. The other way to record it is with a journal entry. Okay, so I just deleted that, so it's going to be out of here. So if I click on back here, it diminished that income, and it's no longer there because I deleted that. See that? Okay, so now it's back into that liability account, and I'm going to show you the other way to do it, which is through a journal entry, and create and I'll create a journal entry, and I'm gonna debit the liability account. So let's see, deposit. Oh, no. Deferred revenue. I'm sorry. I'm gonna go into deferred revenue. The deposit is under the reason why here I put deferred revenue is because it's a journal entry looking at the chart of accounts account, and when I create an invoice, it's products and service. Okay, so that you know the difference. All right, so here I am going to say that I'm removing this liability. So I'm gonna debit the liability account. When I debit a liability account, I'm lowering that liability. I'm taking away from the liability, and I'm going to credit a sale account. And that sales account would be whatever income account that we're going to put this under. So it could be service, it could be design income. You can put it under design income, okay? And the result's going to be the exact same thing, except that this is a journal entry. The other one was an invoice, a zero balance invoice. So, but the bottom line is the same. So design income now increased by $200 again. And you see the income here, but now it says journal entry, right? And you can put the name on the journal entry too. And that's the right thing to do, by the way. So I can put here as Amy Sanctuary. Oh, I'm sorry. This is the description. The name is right here. Amy Sanctuary. And you can put here Amy Sanctuary as well. This way is going to record that in both accounts, both the short-term liability account and the income account. So if I refresh it, okay, and I enter, now I have this recorded as Amy Sanctuary, right? I if you ask me, do I prefer journal entry or zero balance invoice up? It's up to you pretty much, but the bottom line is the same, as you can see. And if you want to take a look, like I said, on the chart of accounts to see what happened, is exactly the same thing. We go to the chart of account, deferred revenue, and view register, and yes, the exact same thing. We only have that $55. Once we earn that income, we can do the invoice, or we can do that journal entry, or we can do a transfer as well. But the journal entry or the zero balance is what I prefer, actually, because you can put more detail, all the details. What is the client that is paying you, and so on and so forth. Okay. All right, this is it. Yay! This is it. Let's go back here. Okay. All right. Hopefully this was useful to you. So this is how you record deferred revenue. So once again, deferred revenue, you haven't earned the income yet, or you have a liability against it you need to account for in the future. So you just count what you actually earn. The rest of the income will go into a liability account in the balance sheet and be removed into an income account once that service has been fully provided. There's no more liability, and now it's income. So it goes from the balance sheet into the profit and loss. Okay, if you have any question, write down below. I know there's a lot of question on the subject. It is a very important subject to understand, because I know a lot of you may have, you may receive deposits, or maybe, like I said, you have a bundle service, and some of the services that you receive the money for has not been provided yet, so you don't want to count for that income on that accounting period. You want to show that as a liability to the company, and then once you provided the rest of the service, then you remove to the income, so that you can have a more accurate profit and loss, an accurate balance sheet to know what's your liability, what you actually owe, and things like that. Okay. All right. So if you like this video, subscribe to this channel. We're going to be back every week with all kinds of information on how to fix things in QuickBooks Online, how to understand the processes, and how to get your books up to date, not only for your CPA, but also to understand the finances on your company, so you can set your budgets and aim your goals to the right place. Know your point of reference. It's so important to know your point of reference, to know where you want to go next. Okay, I wish all of you a very successful 2024. We're starting 2024 with all excitement, and we hope that you have an absolutely successful 2024. Subscribe to our channel. Write down if you have any question, and be back every week so you can learn and take your business to the next level. Hope to see you next week. And until next time, keep on smiling.